Welcome to Griffonomics.
Glad to be here.
I want you to imagine you walk onto this massive factory floor.
Okay.
And maybe 10 years ago, that floor was just packed, right? Like 100 workers on an assembly line.
Right. Totally full.
But today, you walk in and there are only like 10 people left.
Yeah.
Plus this fleet of highly efficient, completely autonomous robots doing all the heavy lifting.
Which the factory owner obviously loves.
Oh, they are thrilled, naturally. I mean, they are saving an absolute fortune on human labor.
Sure.
But let's say your entire business model, your whole company, was built on selling the office chairs that those 100 human workers used to sit on.
Oh, wow. Yeah.
Suddenly, that amazing operational efficiency is absolutely terrifying for you.
It becomes an existential crisis.
Yeah.
I mean, your entire revenue model is fundamentally disconnected from the new reality of how the work is actually getting done.
Exactly.
You are selling tools for human hands in a building that basically doesn't need hands anymore.
And that exact crisis, that fear, is playing out right now across the entire global software industry.
It really is.
So in today's deep dive, our mission is to unpack ServiceNow's May 2026 Financial Analyst Day.
Which was a massive event.
It was huge. We are looking closely at their transition from a traditional software platform into what they are calling an autonomous enterprise orchestrator.
Right.
So if you've been wondering how AI actually makes money in the real world, beyond all the tech jargon and the endless Silicon Valley hype, this is your definitive blueprint.
That's the real deal.
Okay, let's unpack this because we are looking at how ServiceNow is taking the biggest fear in the software industry, which is AI replacing human workers, and engineering it into a massive financial windfall.
To really understand the mechanics of what they're doing, we kind of have to start with that fear you just mentioned.
The chair salesman fear.
Right. The industry calls it seat compression.
Seat compression, okay.
Yeah, and for a legacy software as a service business, the math is genuinely horrifying.
Because they charge per seat.
Exactly. If an AI agent can automate the routine tasks of a knowledge worker, an enterprise simply needs fewer human workers.
Right.
And since the legacy SaaS model charges a licensing fee based on every human seat using the software, AI efficiency theoretically destroys their core revenue stream.
It's the classic shovel salesman dilemma.
Yeah.
Like if I sell shovels and suddenly one robot can do the digging of 15 humans, well, I just lost 15 shovel sales.
Which is bad news for you.
Right. If AI makes humans more efficient, enterprises need fewer humans and therefore fewer software seats. That looks like a structural death spiral for traditional software.
It does.
But let me push back here for a second. If ServiceNow is actively encouraging their customers to adopt this AI technology and effectively buy fewer human seat licenses, aren't they risking a massive revenue crater before the AI consumption actually catches up?
You'd think so, right?
I mean, it seems like a huge gamble to cannibalize your own baseline like that.
That is the multi-billion-dollar question, and it's what makes their strategy so fascinating.
Yeah.
What's fascinating here is they aren't just hoping AI consumption catches up.
Okay.
They have fundamentally restructured the math through what they call the labor budget unlock.
The labor budget unlock.
Yes. Let's look at their baseline example to see how they bypass that revenue crater you mentioned.
Walk me through it.
Imagine a typical 20-person IT support team.
Okay, 20 people.
That team costs an enterprise about $1 million annually.
Sounds about right. Salaries, benefits.
Exactly. Now, in a traditional setup, roughly 90% of that $1 million budget goes directly to human labor costs.
So $900,000.
Right. And less than 2% of that massive budget actually goes to ServiceNow for the software licenses those humans use to do their job.
Wait, less than 2%?
Less than 2%.
So the software vendor is just fighting over absolute scraps. They are battling competitors for pennies while the enterprise is spending dollars on the human beings actually pushing the buttons.
That's the core problem with the legacy SaaS model.
Yeah.
But here's the inflection point.
Okay.
When a customer deploys ServiceNow's autonomous AI specialists, those digital agents can automatically resolve about 75% of that team's routine work.
Wow. 75%.
Yeah. So that 20-person human team shrinks down to just 5 human analysts.
Who are now augmented by these digital agents.
Exactly. For the enterprise customer, this is a massive immediate win.
Oh, I'm sure.
Their operational costs drop by over 65%, because they are paying for a fraction of the human labor.
And this is where the magic happens for the listener trying to understand the economics of this transition.
Right.
ServiceNow is no longer fighting over that stagnant, tiny 2% software budget. They have crossed the aisle.
They completely crossed over.
By providing the AI agents that are doing the work of those 15 freed-up humans, they are now actively eating into the enterprise's massive, vastly more lucrative labor budget.
Yes.
They aren't selling software to help a human work anymore. They are selling the digital equivalent of the human worker.
Which completely neutralizes the threat of seat compression.
Because they're the ones compressing the seats.
Exactly. Let me give you the specific math they presented. Yes, they lose the traditional subscription revenue for those 15 human seats.
Right.
However, those digital agents don't clock out.
Right. They don't sleep.
They run 24 hours a day, 7 days a week. Because they're constantly working, checking systems, routing tickets, and solving problems in the background, they drive 6.5 times more AI consumption on the platform compared to a human user.
Wait, 6.5 times more?
Yes.
Which means the loss of the human seat revenue is just a drop in the bucket compared to the AI usage fees.
It results in a greater than 5x total spend multiple for ServiceNow.
5 times.
Let that sink in. The enterprise saves a fortune overall by reducing headcount, but ServiceNow's slice of the pie grows exponentially.
Because they capture a portion of the savings from that massive labor budget.
Precisely.
Okay, but this forces a massive operational shift.
How so?
Well, if you are selling fewer human seats, but you are capturing a 5x spend multiple, how exactly are you charging for it?
I
mean, you can't just slap a seat license on a piece of code that doesn't have a desk.
This is what they call the consumption pivot.
Okay.
They transition to a hybrid pricing model that they call Runtime on Assist.
Runtime on Assist?
Yes. Instead of purely counting the humans logged into the system, they are metering the automated actions.
Okay.
Every time an agent does something, whether it's resetting a password, routing a complex supply chain order, or auditing a compliance log, it burns an assist.
So it's metered, like electricity.
Exactly. Their CFO, Gina Mistanzuono, bluntly laid out the philosophy at the Analyst Day. She said, "We don't count seats here, we count dollars."
Man, that is a great quote.
It really sums it up.
Let's talk about the volume of that consumption, because the statistic you shared with me before we started recording absolutely blew my mind.
It's wild.
I want to make sure we get this right.
The volume is staggering because we have to rethink what AI is actually doing.
Okay.
When an autonomous agent is running continuous background tasks on ServiceNow, it consumes 15 times the amount of assists compared to a human just asking a basic generative AI prompt.
15 times the consumption.
15 times. And this isn't some rosy 2030 projection. This consumption model already makes up about 50% of their net new annual contract value.
But why is it consuming 15 times more?
Well,
I think a lot of people, they picture AI as just a chat box. You type a question, it types an answer. Why does an enterprise agent burn so much more fuel?
you have to paint a picture of what a human does versus an autonomous agent.
Okay.
If you ask a chatbot to write an email, it's a single input and a single output. That's one assist.
Simple enough.
But an autonomous enterprise agent is executing complex, multi-step business workflows while you sleep.
Right.
Let's say an agent is tasked with onboarding a new employee. At 2 a.m., it pings the HR system to create a profile.
That's an assist.
Right. Then it jumps to the IT system to provision a laptop and software licenses.
More assists.
Exactly. It encounters an error because a specific software license is out of stock. So it autonomously routes a purchase order to finance, waits for the approval, and then completes the software provisioning.
Wow.
It might execute 30 or 40 independent actions burning assists every step of the way to complete one overall task.
So it's just constantly churning in the background.
Constantly.
And that leads to the architectural secret weapon making all of this possible, the action fabric.
Oh, yes. The action fabric is arguably their most critical strategic moat.
Explain that.
It's a governed integration layer built to allow any third-party agent to trigger ServiceNow workflows headlessly.
Meaning without a human interface.
Exactly.
Here's where it gets really interesting. Think of the action fabric like a universal toll booth on the enterprise highway.
That's a good way to put it.
Let's say an employee uses a completely different AI model, maybe Anthropic's Claude or Google's Gemini, to ask for a complex supply chain adjustment.
Sure.
Claude might be the intelligence processing the request and understanding the context. But to actually execute that order change, to update the inventory database, and to trigger the shipping protocols, well, it has to pass through ServiceNow's toll booth.
Right.
It burns an assist on ServiceNow's rails. It doesn't matter who built the brain. If the AI wants to physically do something in the enterprise, it pays the toll.
It perfectly cements their strategic transition.
Yeah.
In 2019, they called themselves the platform of platforms.
May remember that.
But today, by welcoming all external large language models to plug into this action fabric, they have elevated themselves to the AI of AIs.
AI of AIs.
They don't care if OpenAI wins the model war or if Anthropic does. They're the ultimate orchestrator sitting underneath all of them.
Okay, I have to stop you there.
Why?
Because if you are opening up your core systems, essentially saying, hey, third-party AI models, come run headless automated tasks in our system 24/7,
Yeah.
that sounds like a catastrophic security nightmare.
Oh, absolutely.
If you go to any chief information security officer, a CISO, and pitch that, they are going to physically throw you out of the room.
They absolutely would. When ServiceNow first explored deploying these long-running, self-evolving desktop agents, CISOs flatly rejected them.
I'm not surprised at all.
They viewed them as inherently unsafe. The industry refers to this as the shadow AI risk.
Because an unrestricted agent doesn't have common sense.
Right.
If it hits a credential error while trying to update a system, it might not just pause and ask for help.
No, it might try to fix it.
It could autonomously try a workaround, escalate its own privileges, and accidentally delete an entire production database in 9 seconds.
Which is terrifying.
Or it could misinterpret a vague prompt from an executive and permanently wipe their entire inbox while trying to organize it.
And that very real fear is why ServiceNow initiated Project ARC.
Project ARC, what is that?
It's a strategic collaboration with NVIDIA to build what they call an enterprise harness for autonomous agents.
An enterprise harness?
Yeah. They are using NVIDIA's open shell technology to establish a strict sandbox boundary.
Meaning the agent is operating inside a padded room.
A padded room with no doors, unless the system explicitly creates one for a fraction of a second.
Oh, wow.
The administrators define exactly what the agent can and cannot do, and strictly limit which enterprise systems it is permitted to access. The AI cannot operate outside those parameters.
Okay, I understand putting one AI in a padded room,
Sure.
but an enterprise like Siemens or GE has tens of thousands of employees globally, which means they might have tens of thousands of these autonomous agents running concurrently.
Easily.
You can't have a human security team checking the padding on 50,000 rooms. How does the math on that security actually work in real time? Are traditional security models just obsolete?
They are. You plug every single one of those padded rooms directly back into ServiceNow's AI control tower.
AI control tower.
Yes. Every agent provides continuous telemetry. It constantly reports what actions it is taking, what data it is looking at, and what systems it is trying to access.
So it's constantly checking in.
Right. This gives the security team a holistic, top-down view to govern 50,000 agents simultaneously.
That's wild.
But you are touching on a broader issue. Traditional security architecture relies on humans reviewing logs or setting static permissions. That model is breaking under the weight and speed of AI.
Because an AI operates in milliseconds. If it goes rogue, by the time a human reads the security log, the damage is already done.
Exactly. Which introduces ServiceNow's vision of zero privilege.
Zero privilege.
Think about why this matters structurally. The old idea of permanent access privileges, where an employee or system account just always has an open connection to a database, is incredibly dangerous now.
If an agent gets compromised and it has permanent access, the attacker has permanent access.
Right. To solve this, the AI control tower establishes a dynamic trust layer.
Okay.
Think of zero privilege like a hotel key card that is completely blank.
A blank key card.
Yeah. When the AI needs to enter a room to do a specific task, the control tower writes the access code to the card, the AI opens the door, and the moment the task is done, the key card wipes itself blank again.
That is brilliant.
Access is granted in the moment, strictly for a specific action, and instantly revoked.
Wow.
By wrapping these agents in NVIDIA OpenShell sandboxes and dynamically governing their access through the AI control tower, ServiceNow is building an impenetrable security moat.
It's a huge competitive advantage.
Absolutely. If a competitor tries to offer autonomous enterprise AI without this deep integrated governance layer, CISOs simply won't approve the purchase.
It becomes the ultimate barrier to entry.
Right.
But here is the catch. To govern all of this and to make these split-second dynamic access decisions accurately, the AI needs context. It needs to know the history, the dependencies, and the specific operational rules of that exact company. Which brings us to the data layer.
Yep.
You can have the best AI brain in the world, but if it doesn't have real-time access to the company's data, it's useless.
You cannot separate the AI's execution capabilities from the data it relies on. And the database architecture in most enterprises is fundamentally broken for the AI era.
Explain that. Why is it broken?
Well, historically, enterprises used operational databases for day-to-day tasks, like processing a transaction.
Sure.
But those databases couldn't handle heavy analysis. So companies would use a process called ETL, extract, transform, and load.
Right, ETL.
They would extract the data out of the operational system, transform it, and load it into a completely separate data warehouse just to analyze it.
It's a huge hassle.
The problem is ETL is slow, it's expensive, and by the time the data is in the warehouse, it's stale.
Right.
More importantly, it breaks the context. The AI loses the real-time connection to what is actually happening in the business at that very second.
So you have a super smart AI looking at yesterday's news trying to make a split-second decision today.
Exactly. Which is why the numbers they shared around their new database, RaptorDB Pro, are so critical.
Tell me about those numbers.
We are talking about a product scaling from 0 to $100 million in annual contract value in exactly 5 quarters.
5 quarters, that's insane.
That makes it one of the fastest growing products in the company's history. And these aren't small test pilots. The average selling price is over $500,000.
Because RaptorDB Pro solves that data fragmentation.
It unifies operational and analytical workloads into a single database.
So zero ETL.
Zero ETL. You don't have to extract or move the data. But they took it a step further with 2 new features, Live Archive and Live Connect.
Okay, what do those do?
Live Archive lets customers query both their hot, active data and their cold archive data natively within ServiceNow.
I love this concept. Give me a metaphor for how Live Archive changes the game for an AI agent.
Okay, imagine asking an AI to solve a complex legal dispute. If it only have access to the hot data, it's like a lawyer who only knows what happened this morning.
Not very useful.
Exactly. With Live Archive, that AI certainly has instantaneous access to every legal precedent, every contract, and every email from the last 10 years without having to leave the room to go to a dusty filing cabinet.
Oh, wow.
It maintains perfect context. And Live Connect lets enterprises point their existing external business intelligence tools directly at RaptorDB Pro for real-time analytics with zero data movement.
So it's totally seamless.
Management expects these 2 features alone to expand RaptorDB Pro's addressable market within their existing install base by 10-fold.
So what does this all mean? When you stack all of this together, the labor budget unlock bypassing seat compression, the consumption pivot to counting dollars instead of humans, the zero privilege security moat, and this massive 10-fold data expansion, what does the financial blueprint actually look like for the listener keeping track of the business fundamentals?
It looks incredibly bullish.
I bet.
For 2026, they are guiding for over $15.7 billion in subscription revenue.
$15.7 billion.
But the real jaw-dropper is the 2030 blueprint.
Okay, lay it on me.
They are targeting a base case of $30 billion plus in subscription revenue by 2030.
$30 billion.
With a potential upside path reaching over $32 billion. That represents a roughly 20% compound annual growth rate at massive scale.
To put that in perspective, adding $15 billion in revenue in 4 years means they have to build the equivalent of an entirely new Fortune 500 company on top of their existing business.
Right.
But high growth usually comes at the expense of profitability.
Not in this case.
Really?
No. They are maintaining a financial framework called the Rule of 60 plus.
Rule of 60 plus, Bill.
Now, for context, in the traditional SaaS world, companies strive for the Rule of 40.
Right, 40 is the gold standard.
That rule states that your revenue growth rate plus your free cash flow margin should equal 40% or higher. Hitting 40 is considered excellent.
Okay.
ServiceNow is hitting 60 plus at a $30 billion scale. That is elite execution.
How are they maintaining that level of profitability while growing so fast?
A major driver of that profitability is that they are drinking their own champagne.
Meaning they use their own AI.
Exactly. They're using their own agentic AI internally to flatten the hiring curve. By deploying their own autonomous workforce for IT, HR, and software engineering, they expect over $300 million in annualized cost savings flowing directly to their bottom line in 2026 alone.
That is incredible. But I want to address the elephant in the room when it comes to those massive financial targets.
Okay, let's hear it.
If you are an everyday investor, there is one persistent complaint you hear about high-growth tech companies.
Stock-based compensation.
Exactly. Stock-based compensation, or SBC.
It's a huge issue.
To keep top software engineers, these companies hand out massive amounts of stock. And for you, the listener, if you own shares in a company and that company suddenly issues millions of new shares to its employees, your slice of the pie just got smaller.
Right, your value drops.
The value of your investment is diluted. Are they doing anything to fix that?
It's a very valid concern, and hypergrowth SaaS companies are notorious for ignoring it.
Oh yeah, they ignore it all the time.
But ServiceNow is actively managing it to protect shareholder value. They have committed to an aggressive target of dropping their stock-based compensation to below 10% of revenue by 2029.
10% is a great long-term target, but what are they doing right now to protect the portfolio?
They took immediate, massive action.
Okay.
In just the first quarter of 2026, they executed a $2 billion accelerated share repurchase, or ASR.
$2 billion.
They bought back 20.1 million shares in a single quarter. To put that into perspective, that's nearly double the shares they repurchased in all of 2025.
So they're aggressively taking shares off the table.
By front-loading that $2 billion buyback, they expect to achieve dilution net neutrality for the entire year.
Net neutrality.
Meaning they're buying back enough stock right now to completely offset any new shares they might issue to employees. They are essentially putting a floor under the stock, protecting the everyday shareholder's value while they march toward that $30 billion goal.
It is a ruthless level of operational discipline.
Absolutely.
So looking at everything we've covered today, the 5 times spend multiple on labor replacement,
Yep.
the headless action fabric acting as a universal toll booth and burning metered assists,
Right.
the strict zero-privilege sandboxes, and the AI control tower. And this march to $30 billion while explicitly protecting the share count from dilution.
If we connect this to the bigger picture, the final verdict is that ServiceNow is fundamentally shedding its legacy identity.
They aren't who they used to be.
They are no longer just a software vendor. By orchestrating these deterministic complex workflows and transitioning to the runtime on assist consumption model, they have effectively become an AI utility.
They are building a digital power grid.
That is the perfect analogy. You don't buy a software license to use your city's power grid. You plug your machines in, the grid provides the energy to do the work, and you pay exactly for the watts you consume.
Simple as that.
ServiceNow is providing the governed, secure, digital infrastructure required to run autonomous labor in the modern enterprise. They aren't just a platform that humans work on anymore. They are the orchestrator of the automated work itself.
They took the legacy SaaS industry's greatest nightmare, seat compression, and the fear of AI replacing humans, and successfully engineered it into the biggest growth engine in the company's history.
It's remarkable.
We wanted to look past the AI hype today to see how the money is actually made, and this is the blueprint. It's the monumental transition from capturing tiny software budgets to capturing the global labor budget.
And that leaves us with a truly fascinating, if somewhat provocative, reality to consider as we move into the late 2020s and beyond.
What's that?
If ServiceNow and companies following their model successfully begin capturing vast swaths of the enterprise labor budget, what happens to our traditional macroeconomic metrics? For a century, gross domestic product and labor productivity have been tied directly to human output.
All right, humans doing the work.
But what happens when global economic output is no longer tied to human headcount, but rather to the assist burn rate of a digital power grid? Will we need to invent entirely new economic indicators just to measure the health of the agentic economy?
Risk defined.
And
Portfolio protected.